to the Bridge Capital Market Observations Call. Today's call is hosted by Eric Jefferson, Managing Partner with Bridge. Before we get started, we have a few quick words from our legal team, and with that, we can now begin. Eric, I will now turn it over to you.
Well, thank you, and appreciate everybody taking some time to join us today. Once again, a lot to talk about, and for today's call, really want to focus in on some events that took place earlier this week. The Fitch credit rating agency cut its rating for U.S. sovereign debt, so those are Treasury bonds, from the highest rating of AAA down one notch to AA+, citing a growing debt burden, fiscal deterioration, and eroding governance. Now, along with S&P, Moody's, Fitch is one of the most prominent rating agencies. They, in essence, grade the creditworthiness of various governments, corporations, municipalities. Investors will often leverage them for their expertise and their insight as a way to try and gauge what is that probability of possible default. Now, as you can imagine, the top rating of AAA is reserved for those borrowers that display virtually no credit risk or risk of default. The United States has never defaulted on its debt as well, being the largest economy. We do have the resources in order to issue more debt in order to fund those costs. Now, as you'd also imagine, any changes in that rating, up or down, not only have the ability to impact investor confidence, but also to directly alter the institution's borrowing cost via the yield that they would have to pay to incentivize lenders. Now, to give some context, this is the first time that a major credit rating agency since the debt ceiling crisis of 2011 has downgraded U.S. debt. Only the third time in history this has occurred, going all the way back to 1975. Now, as you'd imagine, many in Washington, including Treasury Secretary Janet Yellen, pushed back against this decision. She offered some assurances to both investors and citizens alike. Treasuries still remain the prominent, safe, and liquid asset. That is absolutely the case. She offered some assurances as well that the U.S. economy remains fundamentally strong. And now Yellen's points are widely accepted, certainly nothing you could disagree with there. However, it's also hard to ignore Fitch's assessment. We have ballooning national debt in the United States. That now, coupled with higher interest rates, means that we are going to meaningfully increase the cost or the interest expense that our government will pay to fund its operations for the years ahead. In 2023, this year, it is anticipated our interest expense will be in the ballpark of $660 billion. That is twice what it was 2 years ago, and many are suggesting that is on pace to reach 1.4 trillion in the next decade. Those projections don't necessarily take into consideration skyrocketing medical costs with an aging population, or the aspect that if inflation does not revert back down to that 2% long-term average or goal for the Fed, that interest rates may have to move even higher from current levels, which would only further increase our debt service on future loans. Now, certainly the COVID-era stimulus meaningfully contributed to the deficit as of late, although this has been an issue facing our country for decades. When we think about politicians on both sides of the aisle, going back to the 1960s, they have come together on 78 different occasions in order to raise the debt ceiling, or the amount that our government can borrow and then in turn spend. That is fairly equally distributed through times or periods when the executive and congressional branches were led by both Democrats and Republicans. More concerning, though, in my opinion, similar to what we saw earlier this year and during the crisis of 2011, when Congress does not come together to agree to raise the debt ceiling, that has required twice now a last-minute sort of 11th hour deal come together to avoid default. If we defaulted, and make no mistake, that is an event that absolutely could trigger a global depression. at the very least, would meaningfully reduce the U.S. standing as the world's financial leader. Now, the market's initial response to these downgrades reflected somewhat of a cautionary tone. However, many in the industry have come out and really offered some thoughts that this wouldn't meaningfully impact the investment outlook for U.S. debt. I think a lot of that response due to the fact that what Fitch cited as the reasons for this downgrade, not really based on anything new. We've known about the debt, we've known about higher rates now for some time. This decision did seem like it came somewhat out of the blue, which has actually caused a few folks in Washington to fuel some speculation on what are the real motivations behind this, particularly with respect to the timing that does seem a little bizarre. I think that certainly is a valid point. We likely will see this referenced in a handful of political ads going forward. But once again, in my opinion, when we saw the response from a lot of folks in Washington, it seems like they are being distracted with this as opposed to the bigger issue at hand, and that is our national deficit continues to balloon as interest rates continue to creep higher. That requires more and more of our total budget, if you will, now being paid to simply finance that budget. If that continues to creep higher, gets to the point where some very tough decisions have to be made. And again, seems like conversation is on how did this downgrade happen as opposed to what should we be thinking about as a nation, as a people, to come together and solve for this to hopefully get us on the right track moving forward. So that's all for today. As always, appreciate you taking some time to join us. And if there's anything I can discuss in more detail, more than happy to. If you don't connect, have a great rest of the week. Take care.